Okay, so we're starting here with this review session going on Unit 14. We're going to be talking about real estate financing. So that's Chapter 14 in your Modern Real Estate Practice book. Should be on page 235, 236 is where we're going to be starting with this. So financing is a big part of what we're going to be involved with in helping our clients, purchase real estate. Not a whole lot of people have cash to be purchasing real estate with, so many times, even people with cash, they're going to want to leverage that out and use some type of financing. So, many homes in the United States, they're bought with borrowed money, and the lending industry is huge, and it's been built to service the financial requirements of home buyers. So it's important for us to be knowledgeable about real estate financing programs and products in order to provide the good service, especially when we're representing a buyer, okay? So our objective in here is we're going to describe the various aspects of housing affordability. We're going to learn some mortgage terms, what investment and tax considerations are. We want to describe the terms, conditions, and use of a promissory note, what that looks like, and then explain the elements and use of security instruments, the mortgage deed of trust, the roles, rights, and obligations of the parties, and describe the different types of real estate transactions, distinctions between judicial foreclosure and non-judicial foreclosure. We're going to talk about that, what that looks like, and what the process involved in each of those. And then we want to describe various consumer protections related to home ownership in real estate financing. So here we are. We're looking at, on page 236, housing affordability. So says here in this little opening paragraph that, because more homeowners are looking to purchase real estate, for a while there, the start of this century, for instance, says creative financing, low interest rate loans, interest-only loans, flexible lending standards. They initiated this ever-broadening pool of borrowers, and then also in financing in the beginning of the century, we had something called a subprime housing market. So the subprime market was meant to provide resources for folks that couldn't purchase with a regular type of a loan like a FHA loan or a conventional loan. They had to get something a little bit more aggressive. So lenders came up with all these different types of financing packages to help people purchase homes. And the downside, and the upside was people got into homes. The downside was people got into homes that probably shouldn't have. And these subprime lending loans, these were loans that you can buy a home with really low credit, meaning in the 400s. I remember seeing people getting loans with their credit in the 400s. Yeah. And then there were loans, if you had a score at least at like 620 or something, you could get a no income, no employment verification loan. So in other words, you can actually get a loan based upon your credit, and you didn't have to prove that you were working or that you were making money or that you even had the ability to pay it back. It was crazy. It was crazy. And the rates on these things, they were higher than the normal rates, and they had penalties on them if you paid them off early. So they truly were, and I did see, this is where, some of the predatory lending practices started to happen, and I did see some of that, and it was a shame. It really was. So it did lead to some of the problems that we had in the Great Recession, but up until and before then, by June 2004, 69.2% of households were homeowners. That was the highest rate of home ownership this country has ever seen. Almost everybody, the majority of people owned a home, okay, in the country. Now, fast forward that by 2012, we go through the Great Recession, and that's where a lot of these folks, like I said, they had high interest rate loans, so the payments were high, and all of a sudden now the value of the property was less than what was owed on the mortgage. People were what you call upside down in the value of their property according to their mortgage loan. So, and they couldn't afford the payments anymore, and I guess, you know, the Great Recession came with it. Unemployment went through the roof. People lost jobs. Businesses went under. I mean, it wasn't pretty, right? We just went through that. Just kind of coming out of it now and going forward. So, yeah, during this time frame, by 2012, a lot of the borrowers had defaulted, and now we had record number of foreclosures. So we had record high of home ownership, now record number of foreclosures, and that coupled with the unemployment, like I said, made matters even worse, so that by 2015, most of the country saw, starting to see a recoup in the sales, property values, but the incomes were still modest. And then in 2014, or 2015, the rate dropped to 63.7% home ownership. So it went from 69, almost 70%, to down closer to 60% of home ownership. You know, of people that own homes in this country. So now, you know, things are starting to turn around a little bit. I'm seeing more people get into homes, and folks that were, in fact, had lost their home, maybe in a foreclosure. You know, the foreclosure time period before you can purchase another home, there's a time period, a waiting period. You have to wait before you can buy another home and qualify once you've been foreclosed on. That time has gone by now, so a lot of those folks are getting back into, maybe they've lost their home, now they're able to purchase again, but they're being a little more careful this time in doing that.
Oh, okay.
Okay, so now let's talk about some mortgage terms. We're turning the page here, 237. There's some mortgage terms I want to be able to go over here with you, and some of these right off the bat you're learning is, like, for instance, the Federal Housing Administrative, that stands for FHA, and then the U.S. Department of Veterans Affairs, the VA. Those two are your government loans that people, a good share of the loans out there are done with these government loans. So especially in our area. In our area, we're a military town. We've got Fort Carson, Air Force. We got the Air Force Base here, Schriever Air Force Base, Peterson, the Air Force Academy. I mean, we're a heavy military town. If you've ever been stationed here, you're probably going to come back here and retire at some point, or come back and move. A lot of people do. So, so a lot of folks use that VA loan, and if not, then they'll use that FHA loan. There's even an FHA VA type of loan out there. That's where a lot of folks use, you know, get their loans from. In addition to that, they also get loans from conventional resources, and we'll talk about that in a little bit, conventional loans. So basically 3 types of loans that we're going to learn for terminology here: FHA, VA, and conventional. So make a little note down in your margin: FHA, VA, and conventional, 3 types of loans that we're going to be learning about here.
Okay.
Now, ownership expenses and the ability to pay we're going to talk about. And the first thing I want to show you is an acronym, PITI. That stands for Principal, Interest, Taxes, and Insurance. So when I mention PITI, I'm referencing a payment, a monthly payment, where that monthly payment will include the principal and the interest part. That would be your loan payback terms, and then the taxes and insurance to be certain that the home is never delinquent on their taxes and the home is always covered under some type of insurance policy, homeowner's policy. The PITI ensures that for the lender. okay? And it lets them know that that you're paying your taxes, so you're not going to lose your home because of a tax default. And in case something happens to your home, if a fire or something, it's going to be covered because you're always paying insurance. So every month, when you make a monthly payment, that monthly payment is being carved up into a part of it's going towards the principal, a part of it's going towards the interest of the loan, and then a part of it's going towards the taxes and insurance for the property. Okay?
Okay.
We reference that as PITI. Okay?
Okay.
So now let's talk about ability to pay, and that comes into this debt to income ratio, or DTI. So this debt to income ratio is to determine whether or not you can afford the monthly payments. And so each one of the loans that are out there, an FHA or a VA loan or a conventional loan, will have a percentage. They like to see a certain percentage of your gross monthly income going towards your home payment, and not to exceed that percentage. So when you exceed that percentage of your gross monthly income, that's when you could have some challenges in qualifying for the loan, because it's looking like you don't have the ability to make the payments according to the debt to income ratio. Okay? Debt to income ratio.
Right.
So in addition to that, they're also going to be looking at the credit report. If you look down there on 237 now, it talks about when they determine what you can afford, there's going to be automated systems that help you get qualified for it. And they're going to be looking at, these automated systems are looking at the three major credit reporting companies, and that's Equifax, Experian, and TransUnion. So go ahead and highlight just above that gray box there to make sure you don't forget the three reporting companies are Equifax, Experian, and TransUnion. Okay?
Right. Okay.
So the credit report, those agencies, when a mortgage professional pulls your credit, they're going to look at all three of those reporting agencies, and they're going to blend a credit report together based upon the information generated from those credit reporting agencies. Okay, they'll use all three of them, and they'll blend a report together, and that'll be your credit report, your mortgage credit report, that will be used to determine how you have been paying on your debt and how much debt you have, and that's going to be a consideration in figuring out if you can qualify for the purchase of the property. Okay, so the credit, and that report, that credit report, is going to give a score, and so that score ranges anywhere from as a low of 300 to a high of 850. That's the range of those scores, and it's called the Fico Score, which is the Fair Isaac Company, and that's the company that blends those three reports together and then generates a score based upon what it's seeing on those three credit reporting agencies. So it's taking into consideration, for instance, how much credit available to you have, how much credit that you've used, how much credit, how much your monthly payments are, what's your track record of paying on that credit. Are you behind? Have you been behind before? Have you, all that's going to show up and reflect on your credit report, and that's what the mortgage people and these automated systems are looking at to see if you have the wherewithal to be able to qualify and make the payments for the mortgage loan. Okay? So now when you look on page 238, talks more about this debt to income ratio, and it's starting to show you some of the percentages in there. So generally speaking, let's say you put 10% down on a mortgage. Okay, that'd be, if you're doing a $100,000 loan, that'd be $10,000 would be 10%, right?
Right.
So then they're going to calculate the PITI, and they like to see, you see here, no more than 28% of the borrower's gross monthly income. That's before taxes. So this kind of sounds a little weird because you don't spend the money that you have before taxes, but that's how they qualify you. They qualify you on your gross monthly income before taxes are taken out. And they like to see your, what they call your front end ratio to be no more than 28% of that gross monthly income going towards your house payment, your PITI. So you look at that first. You want to make sure that's in line, okay? So, and then the next one they look at is the back end ratio, which here, now they're going to add in to your PITI, they're going to add in all your other monthly obligations that you may have. So that would be your car payments, personal loan payments, that would be any type of credit card payments would be in there, student loans, any kind of loan that you might have. We're going to add that on top of the PITI, and then they're going to see, they want to see that that figure is not higher than 36% of your gross monthly income. Okay, so now we're, sure, go ahead.
So now we're saying they're going to average your, they don't want more than 28% of your income going towards the mortgage. And
Correct.
that includes the PITI.
Correct.
Included in that.
Correct.
But that's the interest rate, that's the insurance, all of that, the principal. They're going to equate what that is according to how much you're asking for that loan on that home, right?
Right. So if you're getting a $100,000 loan and it's costing you $1,000 a month, they want to make sure that that's not higher than 28%. That 1,000 is not higher than 28% of your gross monthly income. Okay.
Oh wow.
Okay. And then the back end ratio. Hang on 1 second. Okay, sorry about that. So the back end ratio is when we add in the rest of the monthly payments to that mortgage payment, and now that's what we want to see, no more than 36% of that coming out of your gross monthly income. Does that make sense?
Yeah.
Okay, cool. All right, so the 28 over 36, I want you to just kind of do a little, mark that on the side of your margin there. That would be the ratio for a conventional loan. For a conventional loan, 28 over 36 is what they're generally looking for. Okay?
Oh, that's conventional. Okay.
For a conventional loan. When we start talking about FHA and VA loans, I'll go over what those ratios look like. But right now, let's just kind of just put that in the margin. Conventional loan, 28 over 36. That's your front end and your back end ratios for debt to income. Okay?
Yeah.
All right. Now, as we continue down the path here on 238, page 238, it talks about investment considerations. So, there's all types of financial advantages to a buyer in purchasing a home. And, when the value of the property increases, then they get equity into the home, and home's worth more than what they bought it for. When they sell it, they can use that to put more towards their next home or cash out, whatever they choose to do. So the equity is another mortgage term. I want you to understand. You'll see that in bold there. Equity is the difference between the value of the property and what is owed on the property. So the property is valued at $150,000 and you owe $100,000, there's a $50,000 equity in there then. Okay? That's what equity means. Now,
okay, so the value of the house is, you said, is $150,000. That's the value of the house.
and your loan is 100, then your equity
And
would
your
be
loan
50.
is 100. Okay.
Yep, that would be 50.
All right, and then the equity is, now the equity is that's your profit.
Right, that's your profit. Exactly. Well, that's your, I wouldn't call it profit. I wouldn't do that. The reason being is when you sell, you're going to have some expenses, right? So profit is always after expenses. So equity
Okay.
is what is, again, the difference between what is owed on the property and what the value of the property is. That's your potential windfall gain is that equity. Okay.
Okay.
Okay. Now there are some tax deductions and benefits from owning property too as well. So mortgage interest payments. Okay, on the first and second home for mortgage balances below $1 million or $500,000 if you're married filing separately. Okay, you can deduct the interest from your gross income. So if you have, let's say, you paid $12,000 in interest over the year, you can take that $12,000 and deduct it from your gross annual income, and now that net is going to be what you're going to be taxed on. So it lowers your tax rate by owning property. It's the interest that you pay on it. That's real good. That's real good. In addition to that, your real estate taxes is also something that you can deduct on your income taxes. Okay? When you first purchase the property, there's certain costs that you incur, one-time costs that you incur when you purchase, and you may be able to take that off of your taxes too. So when somebody purchases a home, the following year, they're going to have some pretty good tax deductions to be able to put on their tax returns. Okay?
Yeah. Yeah.
So you see in there on 239 some of the other bullet points and the things that you can deduct. Now, there's some other tax benefits over here. So when a married couple who files a joint tax return, they sell their principal residence, okay? And they sell it up to $500,000 in profit. That's that equity. Now, that's the profit. The equity minus the expenses is your profit. So if they sell a property and they have a profit up to $500,000, okay, they don't have to pay any capital gains tax. Now, capital gains tax means that you've made an investment and you've made money on that investment. So that's like, working for somebody, like income. That's income. And the government is going to tax you on that income. Well, there is a capital gains exclusion for when you sell your property for married couples. If you sell your property and your profit is $500,000 or less, you will not have to pay any tax on that gain for that year. If you're single, it's $250,000. So again, those numbers is the profit. It's not the cost of the home. It's the profit that you're making on it. So that's what you can expect to save on having to pay any kind of additional tax because of those capital gains exclusions. So you may get a question on the exam about capital gains tax. And what you need to understand for that is, for married couples, they can have a profit up to $500,000 with no tax. For single people, up to $250 with no tax, and that's the profit that they're gaining on that sale. Okay?
Right. So for a married couple, they can't exceed more than $500,000. Now, if they exceed $550,000, then that means they can tax that income.
They'll tax it. So if they gain $550,000, they'll get a tax on the $50,000 because they're exempt up to $500,000.
Oh, they still will be exempt of the $500,000. They can only tax the over amount. Okay.
Correct.
And if you're single, it's $250,000.
Correct.
But whatever you go over that amount, that's the only portion they can do the capital gains tax on.
Correct. Absolutely. Okay. Now we're going to talk about a promissory note. So a promissory note, another mortgage term here. A promissory note is the note where the terms of the loan are going to be outlined in detail on how you're going to be paying that loan back. All right? That's what they call a promissory note. I promise to pay the loan back under these terms. So it's a promissory note. It is what we call a financial instrument. It's a financing instrument, and it is negotiable. Now, let me explain to you what I mean by that. Okay. So it's negotiable, meaning that it's kind of like a bank draft or a check. Whoever holds that note, so you go to ABC Mortgage Company, they hold the note, the promissory note. If they decide they want to have somebody else make the collecting of that note, they can sell that note to somebody else to collect the payments over time. Okay? So that's what we mean by these notes are a negotiable instrument, and this is what banks do all the time. They'll collect and bundle a ton of these promissory notes, and they'll sell those in a bulk sale to a company that what they're going to do is just collect those payments over time. So they'll probably sell that at a little bit of a discount to that company. And then that company now you'll make your payments to a different company. So that's what happens sometimes when people purchase a home, and all of a sudden they got a loan from their one place, but they're not making payments anymore to that company. That note was sold to somebody else to collect the payments over time. Okay? So these things are done all the time, like I said, and that's what we mean by saying it's a negotiable instrument. Okay?
Can I ask a question right there?
Sure.
What would be a criteria for somebody to end up with a promissory note for their loan to be sold to someone else, opposed to not having a promissory note? What would make my loan in a position to qualify for a promissory note?
So every loan is going to have a note that will outline the terms of the payback of that loan, and that is called a promissory note. So every single loan has a promissory note.
Okay.
Okay? It'll say, on the note, it'll have your loan amount, it'll have the loan payments, the term, the interest rate, when they're due, if there's a penalty for being late. All of that's going to be spelled out in the promissory note, and every single loan will have one of these things. Okay? Okay. So now let's go ahead and talk about interest a little bit. Page 240. So interest is what the company is going to charge for the use of their money, because you're borrowing that money to make this purchase. So the interest is what you're going to be able to, we learned earlier, to use as a tax deduction. All that interest that you pay over the course of a year, you can use that as a tax deduction. And on page 240, it's showing you how to determine how to calculate some of that interest. And it also talks about this thing called the loan to value ratio. So I want to talk a little bit about this loan to value ratio. And the loan to value ratio is the percentage of how much of a loan you're going to get according to the value of the property. So let me explain, I'll give you an example. Make it real easy. We're getting a loan for $90,000, okay? The value of the property is $100,000. So far so good. Value of the property I'm buying, it's costing me $100,000 to buy this. I'm getting a loan for $90,000. So what I've done is I've gotten a loan for 90% of the value of the property. You see that? $90,000 loan, $100,000 sales price. I got 90% of it on a loan. I had to put 10% down. So I put $10,000 down, got a $100,000 property. I have a $90,000 balance. That's a 90% loan to value. Do you see how that works?
Yeah.
Okay, perfect. Perfect.
Because some people don't qualify for the full value of the house. They may only qualify, like you said, for $90,000 maybe, and then they got to put the other 10% down.
Could be that, and also, yeah, it could be that they need to have that much down to qualify because that's all they could qualify for. Yes, you're right. Or it could be because the type of loan they're getting, maybe the type of loan they're getting requires a minimum of 10% down for whatever reason. Okay? If it was, maybe they got a loan for where they just needed 5% down. So now they got a loan for this $100,000 sales price for $95,000. So if that were the case, let me ask you, what would be the loan to value ratio with that scenario? $100,000 sales price, $95,000 loan. What's the loan to value ratio?
You said $95,000 to $100,000, and then the $5,000 is the down payment, right?
Right. So what would be the loan to value ratio?
Oh, I'm not getting that right. The ratio. Okay.
Okay.
Well,
so when I got a loan for $90,000, and my sales price was $100,000, I said I had a 90% of that $100,000 went to a loan. 90% of it went because I have a $90,000 loan. You seeing this? I'm using numbers that are equal so you can see it. Does that make sense to you? Okay. So then if I have a $95,000 loan and my sales price is $100,000, what's my loan to value ratio?
It should be 95%, right?
Right. Perfect. It's too easy. Exactly right. Don't make it too hard. It's really that easy. Okay?
Okay.
So it's a 95% loan to value. Perfect. You got a good understanding of how that works then. Okay?
Right.
Now, in addition, there's some math concepts in here to help you figure out what the interest is over the annual interest. And I'll be working with these math problems with you throughout. So don't get all bunched up because you're not quite getting the financing part of this math here. I'm going to help you with that, especially when we get into talking about prorations and stuff. I have some examples that'll bring it crystal clear. But I'm going to show you one right here, right now. So let's say that we had a loan, calculator out, of a sales price of $100,000. Well, you keep that same example, right? And I've got a $90% loan to value, which means I have a $90,000 loan. Okay.
Right.
And let's say I had a $90,000 loan, and I was paying 4.5% interest on that loan. You could get a question that says, what's the annual interest that you would pay? What is the dollar amount, the annual interest that you would pay in that year for that $90,000 loan at 4.5%? Here's how you do that. You would take $90,000 and you would multiply it times 4.5%. That will give you an answer of $4,050. $4,050 would be the interest for the year. Now, if you wanted to know what that looked like on a monthly basis, you would just divide that by 12, and you'd be paying $337.50 interest on that loan every month. That'd be the interest portion of that PITI that I was telling you about. Okay? Is that making sense? Okay,
yeah.
terrific.
So what I want to read back to you is, you will take that loan amount of $90,000 times the 4.5% interest. That would equal $4,050 for the year. But if we wanted to know what it was monthly, we would divide that by 12.
Yep.
And that would tell us what our monthly interest would be for that year on that loan amount for that house valued at $100,000.
Correct. So far, so good.
Right?
Yep. So far, so good. Good job. Okay. Now, the next thing I want to talk about is something called usury. On page 241, it talks about usury. So in this paragraph, what is usury? Usury is when you charge interest in excess of the maximum rate allowed by law. When you charge more than the law allows you to charge, that's called usury. All right? So, usury, let's see here, they show that in here. I thought they did. It must be in the state section. Yeah, in the state section, I'll go over what the state usury for Colorado is. It's pretty high. It's like in the, I think it's like 28% or something like that. It's pretty high. So if you charge more than that, then you really are, taking advantage of people. But it says here, as of March 31st, 1980, federal law exempts federally related residential first mortgage loans made after that date from state usury laws. Okay, so that means that they're exempt from that usury law as of March 31st, 1980. So the federal-related transaction, that's something that involves a federally chartered or insured lending institution. So it's one of those government loans, or it probably is also those conventional loans too, because we're going to learn here in a little bit, many of those conventional loans are now backed by the federal government, and I'll go over those in detail with you in a little bit. So for usury, just understand usury is when someone's charging more than what the law allows you to charge. And federally related mortgage loans are exempt from usury laws. Those two things you got to know.
Okay.
Now for loan origination fee, we're talking about now some of the costs involved in getting the loan. When you first get the loan, there's going to be some fees and charges to get the loan. And one of those is going to be a loan origination fee. The loan origination fee or transfer fee is what they charge the bank or mortgage company is going to charge just to get the loan. And it's typically 1% of the loan amount. It could vary, but typically it's 1% of the loan amount. So in other words, if you've got a $100,000 loan and you have a 1% loan origination fee, one of your costs is going to be $1,000. Okay? $100,000 loan, 1% of that is $1,000. So that would be a loan origination fee.
A lender is going to charge?
That's what the lender is going to charge. Correct.
Okay.
And that's an upfront fee. That's going to be a cost that you're going to have to pay when you close on that loan. Okay? That's part of your closing costs. So when purchasing a property, there's buyer costs and there's seller costs. This would be a buyer cost, the loan origination fee. Okay? Now, in addition to that, there's something called discount points. So let me explain to you what discount points are. So to do that, I want to also bring up another term called yield. You see that there? On page 241, discount points are used to increase the lender's yield or rate of return. So go ahead and highlight yield, rate of return, because that's the definition of yield. It's the rate of return. Okay?
Okay.
Now, discount points, so let me back up a little bit. So when you're paying, let's say that 4.5% interest that we saw over the course of a year was $4,050 on a $100,000 loan. That's part of the yield, that's part of the return that the bank is getting for you borrowing their money. They're like making an investment into you, and they want a return on the investment, and that's the interest that you pay. So that's the part of the yield that they're gaining on their investment. Okay? Now, when they charge discount points, they're charging those to increase their yield. Why are they charging discount points, you may ask? Well, they may charge discount points if you, the borrower, may ask them to provide a lower rate than what the prevailing rate would be. So let's say the prevailing rate is 4.5%. But the borrower is saying, you know, I'd like to get 4%. How can I get 4% instead of the 4.5%? Can I get a 4% interest rate? How can I get that? And the lender would say, sure, I'll give you a 4% rate, but here's what I'm going to have to do. You see, I was getting a certain yield at 4.5. If I charge you 4, I'm not going to get that much of a yield like I was at 4.5. I'm still willing to give you 4%, but here's what I'm going to need to do. I'm going to have to charge you a couple of discount points so that I can still get the yield that I'm looking for, and then I'll go ahead and give you that 4% interest rate. Okay? So that's what's called buying the rate down. When someone buys the rate down, the bank's going to charge them certain amount of discount points for the buyer or the borrower to get a lower than prevailing interest rate. Okay? Does that make sense?
So if you're buying the rate down and they give it to you at 4% instead of 4.5, how are they going to make up the difference? Where are they going to put that extra at? If you're getting a discount up front because you're getting a lower interest rate, how are they going to end up making up the difference?
Because they're going to charge you, let's say they charge you 2 points. And a discount point is equal to 1% of the loan amount. So let's say you come in and you want to get a 4% rate instead of a 4.5. The bank charges you 2 points, which would be 2%, which if your loan amount is $100,000, that'd be $2,000 they would charge as part of your costs to get the loan up front. You would pay that at closing. So they would collect that when the loan closes right away, and then it'd be okay to collect the other part of their yield, the 4%, over time. So what's happening? You see that?
Yep, I see it now, because it's kind of like you're giving that up front, but then they're stretching it out with that 4% over time.
Correct.
Instead of the 4.5%. But you got to pay up front those 2 points, which would equal $2,000 if it's 1%. Yeah, for the points. I see.
Yep, exactly. Okay?
Okay.
So that's what discount points are. It's a way for the lender to increase their yield, and it's usually because of either a risk factor. So people maybe with lower credit, they may do that. And also people that are looking for lower interest than prevailing rates, they're going to charge some discount points so they can still get a good yield. Okay?
Okay.
Now, again, discount points and loan origination fees, they could be also a tax deduction for you, as we talked about earlier.
Okay. So just a quick question to go back to that usury. If you do the point, it still got to equate to where it's not too high with the usury percentage on interest, right?
Well, that's a great question. I'm glad you brought that up. So the usury has to do with the interest rate that you're being charged. The discount points are not part of the interest that you're being charged over time. That's just an additional fee for the bank to increase their yield. Okay?
Okay.
So usury, yep. So usury is just referring to the rate that you're being charged over time.
Okay.
Okay.
I see now.
Okay. So now let's talk about this prepayment penalty, 242. So some loans, especially during the subprime era that I mentioned to you, they used to have prepayment penalties if you were to pay it off early. They would charge another, 1% or 2% of the loan amount. Again, increasing the lender's yield because you're paying it off early. I was hoping to keep this loan, for the next 20 years, and you're paying off early. Well, I'm missing out on all that interest, so we're going to have to charge you a penalty so we can recoup some of that yield. That's why the banks were charging a prepayment penalty on those loans. And again, that was primarily in the subprime loans. Today, there are no longer prepayment penalties on purchase mortgage loans. They're illegal to do, so you won't see any prepayment penalties on people that are getting a loan to purchase a property. Okay?
Oh, okay.
So now let's talk about what's a security instrument. So the note, okay, the promissory note, that's a financial instrument, and that laid out the terms of how you're going to pay it back. But what's securing the loan, that note? Well, the house is going to secure, you say. Okay, well, how are we going to do that? Okay, this is how we do it. We create a security instrument, and we do that by this term called hypothecation. Okay? Hypothecation means the debtor is going to retain the right of possession and control of that property while the creditor receives the equitable right in the property. So let me explain that. First of all, I want you to highlight that because those are terms I need you to really get down, okay? Highlight to the bottom of 242, hypothecation is, and it goes to 243. The debtor retains the right of possession and control of the secured property while the creditor receives an equitable right in the property. So let me break it down into easy terms for you to understand now.
Okay.
So hypothecation means that I'm the bank. I'm going to give you the money for the loan to buy this house. I'm going to let you live in the house. I'm going to hypothecate that I have equitable right in that property, meaning since I'm giving you most of the money to buy that property, I really have the right to buy that property. I'm just letting you live in it right now. So you're hypothecating the property to me. It comes from the term hypothesis, right? When you're doing a hypothesis, you're creating a type of statement. You're making a statement about something, and now scientifically you got to prove it. Okay? So this is the same type of thing. You're hypothecating that I'm making a statement stating that I'm letting you live in the home, and the borrower's letting me, the bank, have equitable right, make sure you know that term, equitable right, to possess that property if you don't make the payments. So if you don't make the payments, we're going to foreclose on you because it secured that note that you promised to pay with those terms. You failed to make those terms, so therefore we're now going to take our security instrument, we're going to take our property back with that security instrument. Okay?
Okay.
So far, so good?
Uh-huh.
All right, terrific. So now let's go over to 243. We're going to talk about a mortgage loan. So a mortgage loan, here's some more terms for you. A mortgage, that's a lien on the real property. The mortgagor, the borrower, is the mortgagor. Okay? The lender is the mortgagee. So here's where we got to start understanding who is who in some of these terms. Mortgagor is the borrower. The mortgagee is the lender. Okay? Now, when the loan is paid in full, right, the mortgagee or the lender, they're going to issue something called a satisfaction of mortgage, which that'll be filed in the public records to let everybody know that you paid that loan off. Okay? So if you do not pay that loan off according to the terms, and they have to take the property back with a mortgage, they're going to do what's called a judicial process for foreclosure. It's a judicial foreclosure, meaning they have to take you to court to foreclose on you. Okay? So they take you to court to foreclose on you. Now, this is what's called, states that do this, in a state that does this, it's called a lien theory state, lien theory. So, like New York is like that, okay? Where you have a mortgage, and when they need to foreclose on you, they have to take you to court to foreclose on you, okay? That's a lien theory state, right? So when you look at Figure 14.1 down the bottom of 243, you're seeing how that kind of looks. It looks like you are, when the money is borrowed, right? There's two parties to this system, only two. You got the mortgagor, the person who's borrowing it. They go to the lender, and the lender gives them the money, and the borrower signs a note, and they sign a mortgage. That's the security, the hypothecation of the security of that loan. When the money is paid back, okay, the mortgagor, borrower, they pay the loan in full, then the mortgagee, the lender, issues out a satisfaction of mortgage to, and they file that in public records. Okay?
Okay, public records, okay.
Okay. Now let's talk about, that's again, two parties, it's a lien theory. You call that a lien theory. Now let's talk about a deed of trust. So a deed of trust is another security instrument, okay? And it conveys, let's look at this here, at the bottom, it says a trust deed, deed of trust. You can say that either way. You can say trust deed or deed of trust means the same thing. So this sentence says, a trust deed conveys bare legal right, title, and then in parentheses it has naked title. I want you to highlight that. That is, title without the right of possession from the borrower to a third party called the trustee. So this system is called a title theory system, and it involves three parties. Okay? So we'll turn the page here, and we'll see on 244, you've got now a third party here. Look at that figure 14.2 on that page, and it shows this three-party system using a deed of trust. And this is, again, a title theory state that does this. We are, in Colorado, a title theory state, so we use this three-party system. So let's make sure you understand this. All right.
Oh, it's different than the lien theory state. Okay.
Right. It's totally different. So with this, you have you don't have a mortgagor, you have a trustor. That's the borrower, is the trustor. Okay? The trustee is not the lender. That's the third party that holds that naked title that we just talked about. You'll see here a box for the beneficiary. The beneficiary is the lender, is the bank. Okay?
So the beneficiary would be like Wells Fargo.
Correct. Correct. So you go to Wells Fargo, and they give you a loan, and they draw up a promissory note, and that's the financial instrument, and then they secure it with a deed of trust. A deed of trust, that's the security, okay, that this trustee, so in our case here in El Paso County, we use the public trustee. It's the El Paso County Public Trustee. They hold that deed of trust, the security, the hypothecation of your property. The trustee holds that, all right? So now this third party, if you don't make your payments according to the promissory note, and the beneficiary or lender has to foreclose on you, with this type of a system, you don't have to go to court. It's already built into the deed of trust. It's outlined in that document, that deed of trust. So that deed of trust is going to have the property on there, the property description, and it's going to have the remedy if you don't make your payments according to the terms on the promissory note. The trustee can start initiating foreclosure upon you. Okay? So you don't have to go to court when you're using this type of a system.
Okay. So the naked title, the trustee, or the naked title, as you can also call it, El Paso County in our state is the trustee that handles that deed of trust.
Correct.
They're the one that secure the deed of trust. So you don't have to go to court, you're saying, if we don't comply with Wells Fargo promissory note, which is the lender, they can automatically begin to seize the property back from us without having to go to proceedings to court, right?
Correct, right. They don't have to go to court, but here's what they do have to do. So
okay.
The beneficiary, when you stop making your payments to the beneficiary, usually after about 3 months or so, they're sending you letters out, got to make your payments, you're not making the payment. Well, then they notify the trustee. The beneficiary notifies the trustee and says, hey, they're not making the payments, start issuing foreclosure. Okay? So then the trustee will start the foreclosure process on you, and they don't have to go to court to do it. Just upon the instruction of the beneficiary, they can begin foreclosure.
Okay, got it.
Okay?
Mm-hmm. Yep.
All right, terrific. Now, when you make the payments in total, in other words, you pay the loan off in full. When the money is repaid, okay, then you pay the loan off to the beneficiary, and the beneficiary has to notify the trustee to release that deed of trust, or they do what's called a deed of reconveyance. Let's break this down. Reconveyance. So the first time they do it is they convey the deed, and now they're going to reconvey it back to you. That's all they're doing. They're returning it back to you. Okay? That's all they're doing.
Mm-hmm.
All right. Terrific. So that's how the deed of trust works. Three-party system. You will be tested on there.
Okay.
All right. Now let's get into 245. We're talking about the duties of the borrower in here. So the duties of the borrower, it shows in here, you've got to make the payments in accordance with the terms of the promissory note. Make sure you're paying all the real estate taxes, property as a security. You got to maintain insurance to protect the lender in the event the property is destroyed or damaged by fire or whatever other hazards out there. It's up to the borrower. They have to maintain the property so it's in good repair, and receipt the lender for making any major alterations to the property before you do it. So in other words, if you get a loan, at a 90% loan to value, meaning that most of the money that's in that property is coming from the bank, and you decide to tear the property down and rebuild something else on there, the bank probably is going to have some say into that because they're the ones that have most of the investment into that property. Make sense?
Oh,
Okay.
yeah.
Okay, good. Now, again, provisions for default. Provisions for default, so this mortgage or deed of trust is going to have something what's called a acceleration clause. So that's just a verbiage that's going to be in there that'll assist the lender when they have to foreclose. So if the borrower defaults, the lender can say, I'm going to make this whole thing all due and payable right now. I'm going to accelerate the due on sale. So instead of it being 30 years down the road, it's all due now. That's what the acceleration clause does, and that allows them to go ahead and foreclose on the entire amount of a loan with that acceleration clause. Brings everything all due and payable. Okay?
Why would they do that?
Well, because the loan is for $100,000 over a 30-year term. Well, you haven't been making the payments, so I'm going to take that 30 years and I'm going to accelerate the debt to the right now, so I can foreclose on the total amount that I lent you, and now I'm going to get my money back.
Man, they're going to put all, well, that's a lot. Okay.
Sure, because they're not going to foreclose just upon 1 year's worth of interest or loan amount. They're going to be on the whole entire thing, and the acceleration clause provides for that.
Okay, I see.
Brings it all due and payable. Okay.
Okay.
So the next thing is the assignment of the mortgage. So again, as we talked about earlier, these are negotiable instruments that the note could be sold to somebody else, like an investor or a different mortgage company, to collect those payments, and they do what's called an assignment of that mortgage. So they assign it to somebody else. So like you go get the mortgage from ABC Mortgage Company, and they sell it to Wells Fargo, and Wells Fargo gets it assigned to them. So now they get all the payments sent to them. That's an assignment of the mortgage. Okay?
Mm-hmm.
The release of the mortgage, or the deed of trust is done once you, like I said, pay everything off, and there's going to be another clause in here. It's called the defeasance clause. Okay? This provision of the defeasance clause, the lender is required to execute a satisfaction of mortgage, release or discharge, when the loan is paid in full. All right? So a couple things are happening. By the provisions of the defeasance clause, defeasance comes from the root word of being defeat, meaning that we're paying the loan off. Okay? So there's no longer a need to have a security against me. I'm going to need to have you satisfy or defeat the lien against me and issue me out a release or discharge of that loan. Okay? So defeasance clause and satisfaction of mortgage, a couple more terms we're learning about. Same thing with the reconveyance, also called a release fee. Okay?
So they conveyed it back to me. Okay, when I paid it off.
Correct.
Okay.
Convey it back. You're just going to convey it back. Correct. Okay. Now, taxes and insurance reserves means that, let's go back to the PITI that we learned about. So the P&I is for the loan portion of that monthly payment, for the interest in the loan that you're getting. The TI is the taxes and insurance. And what happens is they're going to create something called an impound or escrow account. When you first purchase the property, they're going to set up this account for your taxes and insurance for that portion of that payment to be funneled into this account, right? So that when your taxes come due over the course of a year, and when your insurance bill comes in the following year, money is in there, has been accumulating over time, and they'll just go in there and pay that out of the reserves that are in that impound account. Okay?
Okay.
So when you get your tax bill, that's just a reflection so you know what your taxes were they'll already have paid that tax bill by taking that money out of your impound account. And every month, you keep on replenishing that, so there's always going to be monies in that account to pay for your taxes and insurance when they become due. Okay?
All right.
All right.
That's
Now,
it.
the flood insurance reserves, if you're in an area that requires flood insurance, you're in one of these 100-year floodplains, then you could get required to have flood insurance. So they'll also set aside funds for that flood insurance too as well, in addition to your homeowners insurance to protect you from fire and theft and such. Okay? Once it's determined that you're going to need flood insurance, the buyer, you're going to have 45 days to purchase flood insurance once you've been notified that's required you to have flood insurance. Okay? Actually, this really does happen in the very beginning. You should be made aware you're purchasing a property in a floodplain. A lender's going to require you to get flood insurance before you even get the loan. Just the same way as you're going to get homeowner insurance. Same way.
I was just going to ask you, it should be like the same with the homeowner insurance, because
Right.
wouldn't that insurance go into an impound account as well, the flood insurance? So in
It
the
will,
event
yes.
that your house is flooded out,
It will.
they would pay that?
Right, it will.
Okay.
So part of your monthly, so if you have to have flood insurance, part of your payment's going to be principal, interest, taxes, insurance, and flood insurance.
Okay.
All right, getting down here when we're purchasing something subject to, or we're assuming a seller's mortgage or deed of trust. So the term subject to, okay, is a term that you're assuming the mortgage. You're taking over someone's payments, and you're taking over someone else's debt, okay? So when the property is sold like this, the buyer is not personally obligated to pay the debt in full. The buyer takes title to the property, real estate, and they know they got to make the payments on the loan. If they default, the lender forecloses, the property is sold, right, to pay the debt. If that sale doesn't pay off the entire debt, then the purchaser is not liable. Some circumstances, they can go back to the original debtor that you assume that loan from. So let me break it down for you. I'm selling you a house, and I'm letting you take over my monthly payments. Okay? Over the next couple of years, you're doing fine. Something comes up, and circumstances change. You no longer can make the payments. They now have to foreclose on you. So the bank forecloses on you, and when they do that and they sell the property, hey, there's still about $10,000 that didn't get paid off on that loan because they couldn't sell the property for enough to pay all the loan off. So there's a deficiency in there. Guess who they're going to go after for that deficiency?
They're going after you, not me.
Right, they'll go after me. Exactly. That's what they'll do.
Okay.
Okay? So that's what it means, subject to. Okay?
Here's a question for you, Mr. Joe.
Sure.
May I ask?
Sure.
Okay, so say for instance you sell me your house, I get in this situation and they foreclose and I owe $10,000. If you have another property of your own, not just this one, can they put that $10,000 as a lien against other property you may have, or taxes or something?
Sure. If I don't come up with the $10,000, they're gonna file a lien against me and anything I own. Absolutely.
Okay. That's okay.
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 Now, in contrast to that, here's another term you're seeing. Third paragraph on 247. You see that term novation? Novation? So novation means instead of you buying it subject to or getting it assigned, we're going to get a novation on that loan. I'm going to ask the bank to do a novation, meaning issue out to Angelia a new note take me off of it, give her a new note, so you're replacing the one I had. So now a couple years go by and you don't make your monthly payments. They sell the property. There's still $10,000 owed. They're not coming to me anymore. They're going directly to you because I asked the bank to do a novation, meaning give you a whole new note. Replaces the original note. You get a whole new note now in your name.
Okay. Here's another big question, Mr. Joe. I know I'm full of questions tonight, but I'm really understanding what you're trying to teach me. One of the things is, in order, say for instance, you're trying to sell me your house, do I still have to go through the same lending criteria as far as the application, or can it just be Mr. Jones decided that he wanted to sell me his property, and I'm just going to assume the payment without having to go through all that lending criteria with Wells Fargo, that bank?
That's a great question. I'm glad you asked that. So here's how it works. That's going to be according to the type of loan that I have on the property currently. Some loans will allow me just to go ahead and have you take over the payments, and you don't have to do any of the qualifying processes. Okay? But only a few type of loans anymore have that. Today, the majority of the loans out there, if you were to take over my payments, you would still need to qualify for those payments, almost as if you were getting a brand new loan. Okay? You still have to qualify for it. All right?
Okay.
Okay. So now you may ask, well, why don't I just go get a new loan? If I'm going to do that, well,
right.
Here's what you're not considering. What's going to happen when interest rates start to go up? When interest rates start to go up, let's say interest rate went up tomorrow and all of a sudden rates are at 6%, right? Other than a big shock in the world, in the economic world,
right.
There's going to be loans out there now, people that own houses with rates much lower than 6%, won't there be? In fact, this is what you're going to be seeing, I predict, in your career, and anybody getting licenses now, in the next 10, 15 years, whatever, you're going to see this in your career. When I first got into real estate, rates were at going from 16% to 18% real fast. They were incredibly high. Okay?
Wow.
And then, over time, they started to go down. Okay? But before then, when they started to inch up, when they were at 12%, then they went to 14, then they went to 16, right? Well, when they were at 12, there were still people that had loans out there at, let's say, 8%. Okay? So when you can get new money at 12 or takes over somebody's payments at 8, which would you rather do?
I'd rather do the 8%.
Exactly. So that's what's going to be, you see, that's why you would take over someone's payment. All right?
Okay.
And as rates start to inch up, as they always will, real estate goes in cycles. And rates are low, but they're starting to go up now, and they'll start to continue to go up. And when they do, there'll be people out there that own property with a lower interest rate. And now it's going to be, rather than go get a new loan, let's work out some terms where I can just take over your current loan with the lower interest payment. What you'll be doing then is buying out the seller's equity. Remember that term, equity, the difference between right, okay? So you'll be negotiating with the seller to buy out their equity so you can just take over their payments.
Okay, so that gives me another question. All right, so now we're at novation.
Right.
So, okay, so let's just say we're at novation. We're going to give Angelia and make this loan hers. So if she defaults in 5 years, they're not coming after Joe. They're going to just come after Angelia.
Right.
Now, if the lending criteria, if I still got to qualify, will I be paying for what the balance of what you owe on the loan at the time of me doing the novation? Like, say for instance, your loan now you only owe $250, but when you purchased the house, it was $360. So
Right.
am I going to be getting it at $250 at my
Yes.
own interest rate, at that interest rate, or do the bank get to determine how much they want to give me the property for still?
No, you're going to take over exactly the payments and the balance that I currently have. And that's why,
Perfect.
yeah, and that's why it's worth $350. You got to negotiate with me. How you going to pay me the $100,000 in equity?
That's a good deal.
Yeah, it's a real good deal. It's a real good deal.
I need that finance. That's a real
Like I
good
tell you,
deal.
when the market changes, right now we've been using. It's been so long, probably the last last 10, 15, 20 years, really. People have been getting new loans, new mortgages to buy property. As rates start to go up, you're going to see more people purchasing property by taking over people's payments. When I first got into real estate, I did lots of transactions where all you had to do was just buy out that seller's equity and take over the payments. And those transactions go fast. You don't have to wait for somebody, appraisals. You don't have to wait for, those can happen within like 2 weeks. You can do that with. You just got to make sure people can move out. That's it. So those things go fast.
But how do you know for listings for that?
It would show it in the listing. It would show it in the listing, the terms. Every listing shows the terms of what the seller would sell it at. So in the terms, it would have somewhere in there where you could take over it would state in that listing where you could take over the seller's payment, just buy out the equity. Okay.
Now what works for people who's in foreclosure status? Like, could they still do that? Instead of them defaulting on the entire loan, hey, let me get somebody who's willing to assume the loan, get me current,
Right.
so I don't foreclose on that.
Exactly. Your mind is starting to think. A lot of different possibilities open the door now when you're able to do that.
Yeah.
Okay, let's keep on moving forward. We're on 247. We're talking about an alienation clause now. I don't want you to get confused over this. This alienation clause simply is a clause in the note that provides when the property is sold, the lender will either declare the entire debt due immediately or permit the buyer to assume the loan at the interest rate acceptable to the lender. So it's also known as a resale clause, due on sale, or call clause. It's similar to the acceleration, okay, where it brings everything all due and payable now. That's called an alienation clause, okay? Just another mortgage term you need to know.
Okay.
Okay, so recording a mortgage or a deed of trust. So the deed of trust and the mortgage, it should be recorded. Matter of fact, it must be recorded in the recorder's office of the county that the real estate is located. See, what this does, it gives what's called constructive notice to the world. Constructive notice. The whole world knows now, it's public record, that there is a mortgage on this property, and everybody knows who has the mortgage and who owns the property, because it's on public records. Okay? So the recording also establishes the priority of the lien. So in other words, when you're purchasing a property, it should be the first lien on that property that shows up. Let's say you needed to go get a loan to go finish off the basement because you had an unfinished basement. So you go get a home improvement loan to finish off the basement. Well, the bank will issue a loan out, and they'll put a lien against the property. That will be now second lien on that property. So they call that a second mortgage, what they call a second mortgage, because it's second in priority in how it shows up on the deed of the property. Making sense? Okay.
Oh, because that's a second mortgage. Okay, yeah.
Okay. To the second, okay, good. So now, if you look on 247 under that, you're seeing here something called the torrents system. It says, if the property is registered in the torrents system, notice of a lien must be entered on the original torrents certificate. Okay, so just kind of highlight that. You may get a question about that right there on the exam. Okay? We'll talk a little bit more about torrents in a little bit. Right now, I just want you to just highlight that. That could be a question.
Okay, it must be
Okay.
original. Okay.
Okay, so we talked about priorities then, recording it. All right, on 248, at the top of 248, another term called subordination agreement. So, it says here, in the event that a second lien has a higher amount than the first lien, the lender may require a subordination agreement in which the first lender subordinates or lowers its lien position to that of the second lender. To be valid, both lenders got to sign that agreement. Okay? So sometimes it happens, right? You get a loan on the property, and maybe you've been paying on it for the last 20 years. You've only got 10 years left to go to pay this thing off. So when you're doing, so that means, and boy, it's been 20 years since you've made some improvements on the property. So maybe you want to do some improvements. So you go get to the bank and say, hey, I always got this paid off, but I'd like to make some improvements on it. And they give you a loan to do a brand new kitchen, right? Stainless steel kitchen with granite countertops, and you get new carpet, and they put a new roof on. I mean, you just do it all on this house now. And wow, now you owe on your second mortgage more than what you owe on your first. So it's kind of upside down a little bit. What will happen is the lender may say, well, because I'm in second position and you owe more than your first position goes, you know, when you sell this, we want to get paid off first because you're owing us more. So we may ask you to go get a subordination clause asking the first lender to subordinate their position so the second mortgage can be first and the first will be second. You see that?
Yes.
Okay.
Yes.
Terrific.
It's almost like Fico. Okay.
All right. Terrific. All right. Now we're talking about types of loans. 248. Types of loans. Well, you have a straight loan, okay, which is an interest-only loan. That means you're just going to take your loan amount multiplied by your interest rate, and all you're going to do is just pay the interest on that loan. Sometimes they call that an interest-only loan, okay? So all you would pay is the interest. So let's go back to that $100,000. So you get a loan for $100,000. We're going to charge you 4.5% on that loan of $100,000 times 4.5%. And I divide that by 12, and you're just going to pay me $375 a month on that loan. You're just paying the interest portion. But when the loan comes due, you still got to pay the full $100,000 back. Okay? That's called a straight loan or interest-only loan. You're not paying anything to the principal, the amount that I lent you, that I borrowed from, that $100,000. I'm just paying the interest on that. Okay?
Oh.
Whereas when I'm making a amortized loan, the term amortized means I am paying part of the loan is going towards the principal and part of it's going towards the interest. Okay? So that's an amortized loan. So it's a level payment, sometimes fully amortized loan. So on these type of loans, and I usually have a chart here that I show you, and I'm going to go ahead and open up the, and so hopefully folks can see this. So I'm going to draw it out so people can see what an amortized loan looks like. So amortized loan kind of has a chart, an L-shaped chart, let's say. I'm going to put the term on the bottom of this chart. So it'll be 0, 15, 30 years on the bottom. These are the years. And up here, I'm just putting in the dollar amount. So let's say I got this $100,000 loan. Okay. That's my principal. And then I'm going to have a certain amount of interest. Let's say I'm paying 4.5% interest. Okay? So with this in mind, here's what's happening. The chart's going to look like this. When you first start making your monthly payment, okay, very little, oops, I did this backwards. Okay. I did something wrong. This is your interest up here, 4.5%. Your loan is down here. There we go. So when you first start making your payments, very little of your monthly payment is going towards the principal, the loan amount that you borrow. Most of it's going towards the interest. Okay?
Okay.
So it's going to start looking like this over time. Kind of creates an X on this little chart that I'm doing. So when you're making, let's say, $1,000 payment, okay, $900 of that is probably going towards interest, where $100 is just going towards the principal of that loan. Somewhere along the 17 to 18 year mark, it starts to balance off to be equal. And then now, after that, you begin to pay more towards your principal and less towards the interest. Okay? So in an amortized loan, you're going to pay the interest off before you'll be paying the principal off if you paid off on the full term of the agreement. So you take a 30-year loan, and it takes you 30 years to pay it off. In the first 15 to 18 years, most of those payments will be going towards you'll have paid almost all of your interest off. Almost all.
Okay.
The actual money you borrow, you're paying off towards the end of that term in a fully amortized loan. Okay? In a fully amortized loan. Okay?
Mm-hmm. Well, now I have another question.
Hopefully you'll be able to see this little chart when you go look at the video. Okay, go ahead.
Yeah. Well, now that they can't do that penalty for paying off your loans early, say for instance you got a 30-year loan, but I want to go ahead and pay maybe 80% of that off in 5 years. The remaining portion of that, will that be more principal or still interest? High interest.
So good question. So if you pay it off early, you can actually save on the amount of interest that what you would end up paying over the full term of the loan. So if you end up paying it over 20 years, if a 30-year loan, you pay it off in 20 years, you're going to save yourself some interest. Not a whole lot, because like I said, most of that interest is paid at the beginning of that loan.
Okay.
So that's amortized. Okay. Now, let's talk about an adjustable rate mortgage, ARM, also called an ARM. All right. So the adjustable rate mortgage, the ARMs, on page 249. This is when you're going to have an interest rate that adjusts according to some type of margin. According to some type of index, not margin, index. So what do I mean by that? So instead of having a fixed rate, like it's just going to be stay fixed at 4.5% the entire term, maybe we'll have an interest rate that starts out at like 3%. But here's the thing. Every 6 months or so, or every year, it could adjust up or down. It could go up or down according to some type of index that it's tied to. So what type of indexes could it be tied to? It could be a Treasury bill index. So you look on the money market, the financials, of Wall Street. You look at what's the Treasury bill or T-bill, the U.S. Treasury bill. What's that interest rate look like? okay, that they're offering to pay on you buying a Treasury bill. So whatever that interest rate is, okay, and that could move up or down over the course of a year. So then your loan will move up or down according to how that Treasury bill performs up or down over the course of a year.
Okay.
The difference between the index and the actual rate you're paying, that's called a margin. The margin is the gap in between the interest rate and the index. Okay, we're going to board here. I'm going to show you again. Hopefully be able to see this. Bring my camera up here again. All right, so we're talking about an ARM, adjustable rate mortgage. All right, first you're going to have some type of an index. Let's say it's a T-bill. Okay, and this index, if I were going to look at a chart, okay, it's going to be kind of moving up or down according to the market conditions of the time. Let's say it's starting over here at, it's paying 1%, and then up here it goes on the down valley, and as it goes up a little bit, maybe they're paying 2% on this T-bill. So understand what a Treasury bill is, right? You go get a certificate from the government, like a bond, and you pay them $20,000, and they pay you a percentage return on that money, okay?
Yeah.
So, and that money always fluctuates over the course of a year. So here's your index, is this T-bill. And then, now here is your rate, your interest rate, your ARM is going to be tied to this. So when this goes down, your rate goes down. When your index goes up, your rate goes up a little bit. It just kind of follows it exactly the same way. All right? The gap in between your rate and the index, that gap is called margin. That's the margin. Okay? So let's say your margin on this ARM was 2%. So if you had a 2% margin on this particular ARM, when your rate was at 1%, then when the index was at 1%, then your rate would be at 3%.
3%.
When the index went up to 2%, then the rate would go up to 4%. When it went back down to 1%, then your rate went back down to 3%, because it always matched that margin in between your index and the rate. Okay?
Okay. Yep.
So far, so good?
The margin kind of balanced it out, up or down. Okay.
Right, right. It always goes evenly up or down. Okay?
Okay.
So that's the margin. Now, most of these ARMs, these adjustable rate mortgages, they're going to have something called caps. Okay? Caps. So you're going to have, under caps, you're going to have adjustment caps. You're going to have rate caps. You can even possibly have payment caps. Meaning, you see, when these ARMs first came out, adjustable rate mortgages first came out, I know because I've been in the business long enough to know when they first came. I was in the mortgage business when they first came out, and there were no caps on these things when they very first came out. So they were very volatile, and the T-bill was the most stablest indexes you could get. But a lot of these indexes were not the T-bill. They could be something else. They could be the cost of funds, or they could be cost of living index. It could be a multitude of different types of indexes this thing could be on. And if your adjustable rate mortgage was based upon a very volatile index, then your rate could go up like no other. And if there was no cap on how much it could go up or down, all of a sudden you could have an interest rate this year of 8%, and next year it goes to 12%. And you're like, oh my God, I can't make the payments anymore, I'm losing my house. And that did happen. That did happen to a lot of folks. And that is where these type of loans got some really bad names, and rightfully so, because there were no caps. Well, when lenders started to put caps on these things, it protected borrowers so they can have a little bit of peace of mind to know that it's not going to be above a certain amount anyways. For instance, it could have an adjustment cap of, let's say, 1%, meaning that no matter how high this index goes up, if the index on this T-bill all of a sudden goes to 4 and my margin is 2, well, my adjustment cap says I cannot adjust more than 1% at a time. So even though I probably should be at a 5% rate, it's going to only let me adjust 1% increments at a time because of that cap. Okay? Same thing for a rate cap. It could have a lifetime rate cap of, let's say, 5%. So that would mean that over the lifetime of this loan, it will never go above 5% above what your start rate is. So if you're starting out at 3, you'll know it can never go higher than 8 at any point in time. Okay? Even if rates went up to 10, you'll be still at 8%. You see that?
Yeah. So now I have another question.
Okay.
So what will make a person not just do a fixed rate? Because that seems like more security to me than doing an ARMS, because you can just be fixed at 6% or 5%, opposed to being able to fluctuate with the margin 2%. They'll take you to 8 or down or whatever to 7%.
Yep.
Why not just across the board just be at a fixed rate for 20 years, opposed to doing this whole ARM thing?
Okay. The reason for that is, it's a great question. The reason that makes these ARMs attractive, when interest rates start to rise, you're going to see more adjustable rate mortgage opportunities at lower rates. They typically start lower than what the prevailing rate is. Okay? So when rates go to 6%, you're going to start seeing ARMs starting at 4.
Okay.
So a lower monthly payment if you're willing to take the risk for it to go to 8.
Right, because once they cap it, we can go back up to 8 next year. So.
Right. So, well, it won't do the 1 year. It would have to go over the increments of what the cap is annually. There's always going to be an annual cap, but it could go no higher for a lifetime over a certain amount. So here's the thing. What most people don't realize, and I've asked this in classes where I've had tons of people in class, who in here has an adjustable rate mortgage? Invariably, someone will, and I'll ask them, and what is your interest rate? And usually that rate typically is lower than the prevailing rate. So in other words, even with our low interest rates that we've had, I've had people in my class that have an ARM, an old ARM, that when rates were at 3%, their ARM was at 2.
Wow.
Okay? Yeah. So it could be a really good loan, and it all depends upon what type of index you have and what the margin is. The lower the margin and the very stable index could get you a better performing and lower rate than what a fixed rate is. Good.
Yeah, the key word is could.
Yeah, it's all bet, but it all depends. You get to choose. If you look at the index and you look at the history of that index, it's pretty stable, and the margin's pretty low, hey, it might be a good decision to make. You'll be able to do the research and be able to choose that. Okay?
Right. Yeah.
All right. Now let's get into here. This next term I want to show you here is called negative amortization. Negative amortization. So I taught you what amortization is. That means a steady decrease in the loan balance over time. Most of your interest is paid up front. Most of the principal is paid towards the end. That's amortization. Negative amortization means instead of the balance going down, somehow the balance of that loan is going up. That's negative amortization, okay? When the balance goes up instead of going down. So, why does that happen? How does that happen? Well, perhaps you can't afford to make the higher payments. So the bank would say something like, okay, your payment's going up, and you should be paying $1,500 a month, and but you tell me you can't afford that. You can only afford $1,300 a month. Okay, here's what we're going to do. We're going to let you pay that $1,300 a month, but you really should be paying $1,500. So what we're going to do is we're going to take that $200 that you're not paying every month, and we're just going to tack it on to the balance of your loan. So your balance is going to go up a little bit each month because you're not making that big payment because we're giving you a lower payment to make. But don't worry, it's all good because property values always go up in real estate, so you don't have to worry about it because the property values are always going to go up. Yeah, that's what they used to say until the Great Recession. We found that properties went down.
Yeah.
Right? So
and then you owe more on the loan at the end because the value of the property is not that.
Yes.
Wow.
So you can see that's a pretty risky deal. Pretty risky deal. Want to stay away from negative amortizations. They're not fun. Okay? Okay, so you understand that concept. Now, the growing equity mortgage on page 249, growing equity mortgage, that has to do with the a rapid payoff mortgage. That's where you're using a fixed interest rate, but the payments, the principal and interest, are going up. So you're growing your equity. So you got a fixed rate of 5%, but your payment is going up a little bit because you're putting more monies towards the principal of that loan, thereby growing the equity in that property. So that's called a growing equity mortgage. Okay? Fixed rate, but the monthly payment's going up a little bit. All right?
Mm-hmm.
Now I want to take you to page 251. I want to show you on here on page 251. This is a mortgage factor chart. You will have this in your testing center on the wall, and you're going to need to know how to use that if you get questions that require you to figure out a monthly payment, because you're not going to have a mortgage calculator to figure out a monthly payment. This chart is what's called an amortization chart, meaning I'm going to figure out what a monthly payment would be for an amortized loan, fully amortized loan. Okay? Show you how to use this chart. So you look at page 251. Let's take a look at the rate of 4%. So you see in here a column for the rate. You see in a column for the term for 15 years and a column for the term for 30 years.
Uh-huh.
Now, when you go to the when you go to, let's say, 4%, okay, let's say we're going to go a 30-year term, all right, and I'm going to be borrowing $100,000, okay? I'm borrowing $100,000 at 4%. It says here, when you look under 30-year term, you just slide your finger over, your factor under that 30-year term for 4% is 4.77. You see that? 4.77. Yep. Okay. So that 4.77, we're going to take, you're going to take the number of thousands in that loan times that factor. So if I'm getting a $100,000 loan, how many thousands are in a $100,000 loan? There's 100 of them. There's 100 1,000s in a $100,000 loan, right? So I'm going to take 100 times 4.77, and that's going to give me a monthly payment of $477. So at 4% for a $100,000 loan, my amortized payment is $477. So far, so good? You seeing that?
So let me make sense of that. We're on the chart, and my home is $100,000 at 4%. It's at a 30-year term, so across there it's 4.77. So it's asking you how many thousands is in 100,000, and it's 100.
Mm-hmm.
So 100,000.
No,
Is it
not 100,000. 100 times 4.77 gives you the monthly payment.
Right, because I just want to make sure I understood the question. Was it saying how many thousands is in 100,000, and it's 100?
Correct.
So 100 times 4.77 equals $477 in interest.
No, that's not interest. 477 would be the P&I, principal and interest, on a fully amortized loan, because this is an amortization chart. So $477 you'd be taking over 30 years, you would pay off $100,000 and all the interest over 30 years at $477 per month.
Oh.
Okay?
I got it. Yeah.
All right, let's try one a little bit harder. So let's say I'm getting a loan for $250,000, and I'm getting a loan for 3 3/4 interest rate. $250,000, 3 3/4 interest rate. So, and I'm going to do it for 15 years, not 30, 15 years. So I go to my rate chart, I look for 3 3/4, I look for my factor under 15 years, and it's 7.27. Now what do I do?
Okay, there you go. So it's 3 3/4. You add 7.27. So we still got to figure out how many thousand is in the 250,000, right?
Right. So how many thousands are in a $250,000 loan?
That's 250
Right.
times the interest. And hold on, let me see. That was 4.47. 15 years is at times 7.27.
Right.
Okay, and that would give us, let me use my calculator. Let me see here. So I'm at 250 times 3.7. Will give me $1,817.50 over the 15-year term.
Correct. Perfect. So after 15 years at 1817.5 every month, after 15 years, I would have paid off $250,000 loan at 3 3/4 interest, and all the interest as well.
Yeah. Yep, there we go.
Okay, see how that works?
And that's monthly over the 15 years to 18.75 PI interest over 15 years. Yep, I see how that works now.
Okay, now let me just give you another question based upon what we learned a few slides ago. What is the annual interest on a $250,000 loan at 3 3/4 interest? What's the annual interest?
Okay, you said what's the annual interest? And then hold up. Okay, we had 3 3/4 loan. I see that. And you saying the loan is $250?
Right, $250,000. So here we go.
Over to Joe.
$250,000 loan. That's my loan amount. My rate is 3.75%. The question is, what's the annual interest? How do I do that?
Oh, that's not amortized. No, because that goes up.
No.
Okay, that's straight loan. Let me go back. How am I missing it, Mr. Joe?
Okay, here's what you do. Your annual interest is simply your loan amount. Let's write this down. Loan amount times the interest rate equals the annual interest.
Okay, so the loan amount times, oh, let me write this down.
Times the interest rate equals the annual interest. So, 250,000 times 3.75% is 9,375. That would be the annual interest that you would be paying every year on that loan for $250,000.
Okay, let me see that. 250,000, I want to see it myself. Times the interest rate, let's put that down. 50,000 times 3.75.
9,375.
Yep, and that's 937.
No, that's $9,375.
Right. Oh,
Okay.
yes, 9,000. I see it, yep. And $75. And that's per year.
Correct.
What you're saying?
Correct.
Per year.
Okay, so now here we are. We've just got you through the amortization chart, and now you know how to do annual interest.
That's interesting. Because
Okay.
you know what, okay, I'm listening.
Okay, so bottom of 251, we've got to keep moving here. It's already 8 o'clock. I wasn't sure how long this would go, so let's keep moving.
Okay.
Now, a balloon payment. Balloon payment loan is when you'll have some part of the loan will be all due and payable after a certain term. So maybe you get a 30-year loan, but in 5 years you have a balloon payment, meaning that whatever the balance is, you got to pay it all off. That's what a balloon payment is. That's all it is. At some point in time, before the full term of the loan, you got to pay it off in full. A reverse mortgage on 252 is a loan that someone would get after they've been in the home for a while. It's for people that are 62 or older, and they've been in their home for a while. They can begin to start getting the equity out of that home without selling it. They'll go to the bank, they get what's called a reverse mortgage. So instead of making a payment to the bank's going to start making a payment to them based upon how much equity is available in that house.
Well, that's great.
Okay. Again, it's for 62 and over. Most popular type of those loans are an FHA loan. Now, foreclosure, when we talk about foreclosure, what is foreclosure? That's a legal procedure in which the property that was pledged for security is sold to satisfy the debt. That's what foreclosure is. Okay?
Mm-hmm.
Now, in a foreclosure sale, okay, the property is sold paying off, it's going to pay off all the liens with the highest priorities first, and then any junior liens, as long as there's enough money to pay them off. So you see the importance of being the first or second mortgage.
Oh, yeah. I was just thinking that.
Right. Back to why that lender that now had a higher second mortgage amount than the first, why they want a subordination to go first. Because if they do get foreclosed, they pay off the liens according to the priority.
Yes.
Okay? That's foreclosure. All right? So, how are the methods of foreclosure on 253? We talked about a judicial foreclosure where you got to go to court. And that would be for lien theory states. And then the title theory states, they use a non-judicial foreclosure because it's built into the deed of trust, into the title. You don't have to go to court. A strict foreclosure sometimes is when the debtor will take the loan to court, even if it's a deed of trust, and the court simply awards full legal title to the lender. No sale takes place. Usually that is common when personal property is used to secure the debt. A deed in lieu of foreclosure is when you're just simply going to turn your keys back over to the bank. And you're going to sign a deed back over to them in lieu of them foreclosing on you. That's a deed in lieu of foreclosure.
Will that still go on your credit?
Yes. Still be on your credit.
Okay.
Maybe not as bad as a foreclosure, but it'll still be on there.
Okay.
Redemption, okay, is the time period that you have to redeem the loan before it actually gets foreclosed on. So each state does this a little bit differently. All right. Some states allow, if you look at figure 14.4, some states allow what's called a equitable redemption. So you can redeem it before the sale. Okay. That's how Colorado is. You can redeem it before the foreclosure sale. But after the foreclosure sale, you're done. Some states allow a period of time after the sale for you to redeem it. That's called a statutory redemption. So that means after you're foreclosed on, you may have a period of time to actually redeem it after it's been foreclosed on you, and you can still get your property back.
I've never heard of that.
Yeah. Not too many states. There's some states back east that do that. I think California might have that. I'm not sure. So now this deficiency judgment, when they do foreclose on you and you still owe monies on that, they couldn't pay everything off on that loan when they sold the property, that's called a deficiency amount. And the lender can go to the debtor and do a judgment. It's called a deficiency judgment against you for that amount that wasn't paid off. So that means that when you get foreclosed on, if there's not enough money from that property to pay everything off, it doesn't just get wiped out. You still could be owed on that. And they can go after you up to 7 years for it.
Wow.
Okay, that's called a deficiency judgment. Now, short sale. Short sale on page 255 is a sale that we used to do during the Great Recession. We offer people to avoid their foreclosure. Don't get foreclosed on. Let's see if we can sell your house with a short sale. What does that mean? Well, that means we're going to actually sell the property for less than what it is owed on. Okay? Well, we have to get, in order to do this, we have to get the bank to agree to short themselves on that loan. And that's where the term comes from, short sale. It's the bank that is shorting what is owed on there because there's not enough in the property to pay it off. The bank may agree to short themselves in order to let the property be sold to somebody else. And at least they'll get what they can get out of it. That's called a short sale. Okay? Now, in that short sale process, you still could have a deficiency in there. And one of the things that, as realtors, we used to do in helping folks get a short sale done on their property is we would ask the lender to please forgive the deficiency on there. If you forgive that, then we can get the short sale approved. Sometimes the lender would do that. They would forgive that debt. In the forgiveness of that debt, whenever you forgive a debt, that's considered to be income by the IRS. So during this time period in the recession, there was a special law put in place to give relief for people that have this forgiveness of debt for deficiencies in their properties after they sold it on a short sale. It allowed them to not have that included as income towards their income taxes. That law expired, went away, no longer is in place. So if we do a short sale today and there's a deficiency still owed on it and we don't get the bank to forgive that, the bank could go after them. If we do get the bank to forgive it, then the seller will have an income event that will have to pay taxes on for that year.
Wow. For that year.
For that year. Okay. All right, now we're going to take a look at some of the consumer protections in here. I'm on page 255. The bottom of this talks about the Dodd-Frank Act of 2010. This was put into place after the Great Recession as a remedy because of all the bad things that were going on in the real estate, mortgage, and lending world. There's some predatory lending going on. There were some practices that weren't good. Dodd-Frank put some stopgaps in there to prevent that from happening. Had to do with certain disclosures. Had to do with the way that the banks respond to the borrowers. So you'll see some bullet points in there on page 256, and also created this thing called the Consumer Finance Protection Bureau, CFPB. There's all kind of talk in the news these days about this CFPB. Okay, so you can look at current events, see what's going on with that. This is what they're talking about, this Consumer Financial Protection Bureau. All right, which was part of another watchdog that was created to oversee lenders in the financing world. Homeowners insurance, we're looking at here on page 256. Homeowners insurance, since the home is the biggest purchase you're ever going to make, most homeowners see the importance of protecting that by insuring it. A lender is going to require it because, again, they have most of the interest in that property by giving you a loan. So you're going to need to get some type of homeowners insurance, and you're going to need to know for the test what the types of coverage there are. So you have a basic coverage form, and then you have a broad coverage form. So look at the bullet points, and you need to get yourself familiar with what the basic coverages are and what the broad coverages are. So study that. You could be getting some questions on that area for homeowners insurance. Okay. I'm going to continue moving on. I'm on page 257. In this section here, it's talking about the Comprehensive Loss Underwriting Exchange, or the CLUE report. It's kind of like a credit report for insurance companies. The CLUE report tells insurance companies what claims have been filed against certain properties. So in Colorado Springs, for instance, boy, we just had a bunch of hail come through here this last few nights. Last night, had a huge hailstorm. In certain areas in Colorado Springs, you get more hail than others. So properties may have more hail damage claims against it than other areas. On the CLUE report, it'll show the amount of claims against those properties. So when a buyer is purchasing the property, one of the things in the terms of the contract allows the buyer to shop for the insurance and make sure they're okay with the rate of premium for the property, of the insurance for that property. So they get in one of these areas that has a high amount of claims against it because they're in a path of the hailstorm that usually comes through. Their insurance on that property may be a little bit higher because the insurance company is going to factor in how many times they got to replace a roof on that thing.
Yeah.
So you may pay a little bit more premium for insurance on those homes than if you would be purchasing a home in a different area. Okay? And they're going to get that information from the CLUE report. The Federal Flood Insurance Program is FEMA. So in '68, Congress enacted this program, and it allows for you to get flood insurance in certain areas where we have floodplains. So you can still purchase homes in floodplains. FEMA administers the National Flood Insurance Program, and they're the ones, the Army Corps of Engineers, they prepare the maps that identify what areas are required to have flood insurance because they're in floodplains. And those things change. They're not fixed, and they're going to stay like that over time. When we had our flooding here several years ago, our flood maps changed. And people that weren't in floodplains all of a sudden were. So they had to get flood insurance. So it changes according to Mother Nature, what it throws at us. Okay?
Oh, like Manatee Springs. Okay.
Right. So National Floodplains Insurance Provider or the designated service company, there's one in each state. Okay? There was a common rating system, or CRS, by taking the floodplain management steps to reduce floodplain losses. So just read this paragraph in here and I'll outline some of the things that has to do with flood insurance.
Okay.
Okay, the bottom of that shows you what's covered and what's not. So read those bullet points. And at the bottom, I want to bring up this RCV and ACV. There are two types of policies. There's a replacement cost value, that's RCV, or the actual cost value. Okay, so there's, depending upon which one you have, policy that you have, your deductibles and premiums are going to vary accordingly.
Okay.
Okay, so that wraps up real estate finance. Okay, now I'm going to go over real quick, I'm just going to go over some of the government controls in finance on chapter 15. Okay?
All
Right.
Okay.
Are
you okay?
Yep.
Come here.
We should be able to finish this up. I'm going to keep on going and keep on pushing through this because I want to wrap this up on this real estate financing chapter 14. Okay. So when we look at this, chapter 15 we're on now. All right. First thing I want to learn with the loans in here is the introduction to the financing market. And the first thing I want to learn about is the government influences the Federal Reserve System. Okay? So the Federal Reserve System, by the way, is a private entity. Even though it says Federal Reserve, the government does not own this thing. It's owned by private banks. Even though they print our money, we don't own it. This is all privately owned. Federal Reserve System. It's a system that divides the country into 12 Federal Reserve districts. So there's 12 Federal Reserve districts across the country. And it regulates the flow of money interest rates in the marketplace through the banks that are members. And they control the amount of interest rate they charge each other. So when you see the Fed is about to raise the rate, they're not raising consumer rates. They're raising the rate that the banks, the member banks, charge each other to keep the money flowing. Okay? That does affect consumer rates. Okay? It does affect investment rates, bond rates, which affect consumer rates indirectly. So it kind of indirectly affects them, but not directly affects them. Okay?
Okay.
So the Federal Reserve. And it has certain reserve requirements, a minimum level of funds that a bank must maintain to operate. They regulate that too as well. All right? So that's the Federal Reserve System. Now, you're going to learn here on page 267 about the primary mortgage market. So the primary mortgage market, that is the place where that lenders originate loans to the public. Primary mortgage market. That's where you and I would go to get a loan. Go to a mortgage company, a finance company, whatever. That's the primary mortgage market. So those, if you look down here, they could be savings associations, they can be insurance companies, credit unions, pension funds. These are all part of the primary mortgage market. Okay?
Okay.
Got investment group financing, mortgage bank companies, mortgage brokers. Those are all part of the primary mortgage market where the public goes to get the money. Okay?
Okay.
Primary. The secondary mortgage market is once those loans are originated, the secondary market is where the loans are bought and sold after they've been funded. So I'll give you this picture of this. You go into the bank, you get your loan, you buy your house, you close on that loan. Okay? You're making monthly payments to it. The bank takes a ton of those and they bundle them together. They take 1,000 of those loans, they bundle them together, and they sell it to the secondary mortgage market to get more money to lend out to more people. That's how the thing flows. Okay? So the secondary mortgage market.
They buy, to that last part one more time, I'm sorry. They sell the loan to a secondary
mortgage
loan
market.
company.
Right.
Okay.
And the secondary mortgage market pays them money for those loans so they can lend out more money to the public.
So the secondary market has to pay more than what the loan is to do that?
No. They pay what the loan balances are. They pay the loan balance.
Okay.
Back to the lender. So they've got a $100,000 loan and they got 100 of these. That's $1 million. They're going to sell up to the secondary mortgage market. Secondary mortgage market gives $1 million for that, so they can lend out 100 more $100,000 loans. See what I'm saying?
Yeah, but that's a risk. Okay, I see.
Okay. All right. Now the secondary mortgage market, there's a chart over here on page 269, figure 15.1, shows you the chart for the secondary mortgage market. These are called government-sponsored enterprises, GSEs. So Fannie Mae, for instance, their function is to be the secondary market for conventional FHA-insured and VA guaranteed loans. They are the ones that also establish the loan guidelines for those loans. So as long as the primary mortgage lender is lending the money using the guidelines that the secondary mortgage market gives them to qualify people at, they can be assured that they can take that loan after it's been funded. Funded means I've given the buyer the money for it. They bought the house. I can take that as long as they've qualified under the same guidelines that the secondary mortgage market gives me. I can assure that the secondary mortgage market company, Fannie Mae, will buy that loan from me so I can get more money to loan out more loans.
Yeah, because isn't that a greater risk for the secondary mortgage market?
No, it's a risk as long as it is not a risk as long as or I should say, it's a calculated risk because they're giving the primary mortgage lender guidelines to qualify somebody. They're telling them, for instance, for a loan, for you to sell this to me up here to Fannie Mae, your borrower's got to have a minimum score of 620. And your debt to income ratio cannot be higher than 41% in the back end. And so they're going to give them all these different, and your time on the job, you're going to have a minimum of 2 years. So these are the certain qualifications that primary lenders require their borrowers to qualify with, and those are really coming from the secondary mortgage market because that primary mortgage lender wants to be able to loan you money and sell it to the secondary market. If he loans you money using those qualifications, he's going to be able to do that.
Right. I guess I'm a little confused on the fact that I get the criteria, but I guess I'm a little confused on if the primary mortgage market has 100,000 loans and you buy 100 of them, what is the profit for the secondary mortgage market? What's your purpose in buying out those loans? Because you're going to
Good point.
Hi, Mary.
Good point.
Yeah,
They're not supposed to be making profit. They're just supposed to keep solvent. In fact, what happened was during the Great Recession, they ended up being dissolvent. So they ended up to get under receivership, and the government took them over, and they are still taking them over. So they're not supposed to be making profit. They're just supposed to help the money flow.
Wow. Okay.
Okay? Okay.
Mm-hmm.
So you look at this chart, you'll see Fannie Mae. Freddie Mac is for mostly conventional loans, and Ginnie Mae is special assistance type loans. Okay?
Okay.
And then you'll read in here some more stuff about Farmer Mac and Ginnie Mae.
Oh, I see that, Freddie Mac. Okay.
Okay? Now, loan programs, we talked about under loan programs, earlier we talked about loan-to-value ratio. You understand how loan-to-value ratio works, right?
Right.
Okay. So now on page 271, it's showing you conventional loans. So conventional loans, they're viewed as the most secured loans because their loan-to-valuation are often the lowest. A ratio could be 80% of the value of the property, meaning that the down payment has to be at least 20% down. And that 80-20 ratio there, okay, is a ratio that the banks like because it's a formula that works for them for risk. It allows the bank to loan you a lot of money still. I mean, they're still loaning you the majority of the property at 80%, but because there's 20% in from the borrower, the bank is okay with that risk. They feel it's a good risk because you got enough skin in the game. You're taking enough risk. Okay?
Yeah, you're paying 20% down now. Yeah, yeah.
You're putting 20% down. So they're okay with that. They like that. That's a formula the bank likes. All right?
Oh, okay.
Okay.
Yeah.
So now, to do that, though, the bank wants to make sure that you have the correct debt-to-income ratios. So you see over here in the third paragraph down, it's showing you debt-to-income ratios, 28/36. You see that? 28/36. 28% is a front-end ratio. So your PITI should be no more than 28% of your gross monthly income. And then your 36 is your PITI, and all of the monthly debts that you have should be no more than 36% of your gross monthly income. Okay?
Oh, okay. Oh, I see it. Yeah, I see it.
Okay.
Let me go back to this real quick. Oh, question. So, is most of the government loans, like we said in the beginning, FHA and VA, is most of those 90% where conventional is 80%?
Okay, that's a great question. That's a great question. We'll go on. I'm about ready to talk about the government loans here in a minute. Just hang on to that question.
Okay.
About ready to go into it. Okay, so page 272 talks about private mortgage insurance. Private mortgage insurance is required on a conventional loan if you do not have 20% down. Let's say you only have 10% down. Now you're doing a 90% loan to value because the bank's going to loan you 90% of that loan, of the value of that property. So for that, the bank's going to require you to get what's called private mortgage insurance. Private mortgage insurance insures the lender in the event that you foreclose, don't make your payments, and you go belly up on that property. They can recoup to get back to their 80% loan to value. So that private mortgage insurance covers that top 20%.
Yep, I see.
Okay? Okay?
Yep, I
So
see.
if you have less than 20%, you're going to have to get private mortgage insurance. So the bank's okay with the 80-20 formula, but if you're getting less, if you're making them go 90-10 or 95-5, they're going to require you to have mortgage insurance for the difference for that 20%. They're okay with the 80% risk. Okay?
Right. But if you get the PMI, can't that make your monthly payment still be higher because you got to have that kind of insurance?
Sure, your monthly payment's going to go up because you got to make mortgage insurance payments now too on top of it. So you're going to have your principal, interest, taxes, homeowners insurance, and now mortgage insurance.
Oh my goodness.
Okay.
Yeah. Yep. I see it now.
Now we continue to talk about an FHA loan on page 273, FHA insured loans. Okay. These are they come from HUD. HUD is the one that administers these FHA loans, and they set the guidelines just like the secondary mortgage market for conventional loans. So they set the guidelines for the debt-to-income ratios and the credit standards and everything else. Okay? And now for an FHA loan, HUD, these loans were meant to be for maybe first-time home buyers. They were meant to increase home ownership in America. These loans were designed for by HUD, right? So because they have the least amount of down payment required. The down payment required for an FHA loan, I want you marking the margin over here to the left, is 3.5%.
Okay.
3.5% is the minimum down payment for an FHA loan. Okay?
Okay.
All right. So, being that as it may, the money's still coming from the bank. They're just doing an FHA guideline, and they're using the HUD standards. The bank's still issuing you the loan because you don't have 20% down. You're going to have to get something called mortgage insurance premium. Now, I want you to distinguish something here for you. On the conventional side, it's called private mortgage insurance, PMI. On FHA, it's called mortgage insurance premium, MIP. Don't confuse those. Get them straight. FHA is MIP, conventional is PMI. Because
FHA is government. Okay.
Right, exactly. That insurance coming from the government. On the conventional side, these insurance for that is coming from a private entity.
Yep.
Okay?
Got it.
Okay. So here's the other thing about the FHA versus the conventional mortgage insurance. On FHA, that mortgage insurance never goes away. I don't care if you've got it half paid off, you'll still have mortgage insurance from FHA. Whereas on conventional, when you get to that 80-20%, the 80% loan to value, you can ask the mortgage company to remove the mortgage insurance, the private mortgage insurance. So you can get rid of it.
Okay.
Whereas with FHA, you cannot. Okay?
Okay.
So on page 274, it talks more about discount points. We've already talked about that.
Yep.
It talks about assumption rules. I'm going to point something out for you for assumption rules for FHA. So for FHA loans, if you were able to get a loan prior to, for an FHA loan, prior to December 15, 1989, you would be able to take over that payment and not have to qualify for that payment.
Really?
So, yeah, but you'd have to find a loan now that was originated before 1989. There's not too many of those left anymore. Okay, it's been a while ago. When I first got into business, there were a ton of them out there. Ton of them. So it was, so if someone had bad credit and they had money for a down payment to buy out the seller's equity, they could just take over someone's FHA payments and buy the house, even with bad credit.
And
However,
even with no income?
Pardon me?
Even if they didn't have proof of income?
Right. So as long as they had the money to take over the payments, they didn't have to qualify for any loans from FHA that were originated before 1989. After December 15, 1989, you now have to qualify, just like you would any other loan from FHA, to take over the payments.
Okay.
Okay? HUD Home Sales. So if you don't make the payments on an FHA loan and you get foreclosed on, that mortgage insurance is going to kick in, and HUD is going to, first the bank's going to foreclose on you, and then the bank's going to file to HUD for the mortgage insurance, and HUD's going to take the property back from the bank. Going to buy it from the bank. And that's where you get HUD homes from. Homes that are sold directly by the government, HUD. Because someone got an FHA loan, they got foreclosed on, the bank foreclosed, and then they applied to the mortgage insurance to have the bank purchase that property from them. Okay? That's different than on conventional. The private mortgage insurance, they don't do that. They only cover that 20% for that bank, remember?
Right.
HUD will buy the property back from the lender in an FHA loan in its entirety. Okay?
Will that make HUD houses less expensive if you do a HUD house because of the nature of that foreclosure, the way they bought it back?
Could be.
Okay.
Depends on the condition.
Okay.
Okay, now the other thing I want you to put down for FHA loan is the debt to income ratios. Debt to income ratios for FHA is going to have a front end ratio of 28% and a back end ratio of 41%.
Ooh.
So a little bit higher ratios on FHA. So they'll allow, actually I think up to 44%. So they allow a little more debt for you to have an FHA loan.
Right.
Okay? Now, VA loans, they're called guaranteed loans. Does that mean they're guaranteed anybody that comes out of the service is going to get a loan? No, that's not what it means. What it means is, it means when the serviceman does come out, he has to qualify for that loan, but he doesn't have to pay any kind of mortgage insurance or private mortgage insurance because the Veterans Administration is going to guarantee it for the lender. What the veteran has to pay is called a funding fee. There'll be some type of funding fee they have to pay. If you're disabled,
like that 1%, like that 1% funding fee. Okay.
It's a little bit higher. It's like 2.25, I think it is.
Okay.
And if you're disabled, you get that waived. You don't have to pay the funding fee. So the Veterans Administration, but you got to know about the VA loans, they're guaranteed by the VA. If they go bad, if you don't make your payments on a VA loan, VA will buy that home from the lender, and now you have a VA repo. Okay?
Right, and you know I'm full of questions. In order to qualify for a VA repo, do you have to be a VA veteran to qualify for one of their homes?
No.
After it's been
anybody can buy a home that was repossessed by VA.
Okay.
Okay?
Okay.
All right. When I look over on page 275, the top part of that talks about some of the eligibilities for VA loans for servicemen. I used to have to actually know this because there was a lot of different time frames where people were in service or not. These days, it's pretty much, as long as you've had 2 full years of service since 1980, you're going to be eligible for VA benefits. The maximum loan for a VA is $417,000 without any down payment. $417,000.
Wow.
Now that's the maximum loan with no down payment. because there's no down payment required for a VA loan up to 417. Anything above 417, can you get a loan for $500,000 on a VA loan? The answer is yes. The thing of it is, though, the difference between 500,000 and 417, let's see, 500 minus 417 is $83,000.
Okay.
So the $83,000, the veteran's going to have to come up with 25% of that, which would be about $20,000. So
Whoa.
the veteran can put $20,000, he can get a loan for $500,000 on a VA loan. Okay? So the veteran just pays 25% of the difference from 417 to the amount of the loan they're getting.
Okay.
Okay? Okay. The next thing I want to talk about is something called a CRV. That's a Certificate Reasonable Value, which is the value that an appraiser is going to give for the property on a VA loan. They're going to give a Certificate of Reasonable Value. That's what the VA appraiser is going to do. So that's another loan term I want you to just be familiar with. It's just the appraised value. That's all it is.
The appraised value. Okay.
CRV. Okay? Now,
Okay.
there's other costs in a loan, okay, like discount rates, loan interest rates, just like any other type of loan. Those are costs that could be associated with a VA loan too as well. But you're seeing here on page 276, it's saying that the seller, under other loan costs, second paragraph, is saying the seller is allowed to pay for some closing costs up to 4% of the loan amount, including prepaid closing costs, the VA funding fee, payoff of credit balances, or judgments for the veteran. So, here's what you're going to learn about a VA loan. It is the only loan that will allow the veteran to pay off debt when they purchase a home. No other loan out there will do that. You can't get that with a conventional or an FHA. But a veteran, if he needs to have some of the debt paid off, the seller can pay some debt off so he can qualify for the loan, but the seller can only do up to 4% of the loan amount can the seller contribute. So in other words, if he's getting a $200,000 loan, the seller can contribute up to $8,000 for the veteran for their closing costs or to pay off debt for them to qualify for them. Okay? 4%.
Yeah, okay.
So that's only with a VA loan can you do that. There are no prepayment penalties on FHA or VA loans. You can assume these loans. For an FHA, you can assume you just got to qualify. For a VA loan, you can also assume you have to qualify, and in order to remove the original borrower, the veteran, you have to replace it with another certificate of eligibility. Your certificate.
So it's got to be
Right.
VA to VA. It's got to be veteran to veteran.
Right. Exactly. Exactly.
Okay.
If you don't, then if you don't get another certificate of eligibility from another veteran, so like someone that isn't a veteran could take over those payments. The thing of it is, it's very risky for that seller who was a veteran that got that loan. Because if I don't make the payments and I'm not a veteran, guess who they're going to go after? The original veteran with his certificate of eligibility.
Yep. So I take it that an assumption rules for VA, they can't do the novation because that person couldn't assume the loan, right?
Correct. Correct.
Okay. Yeah, that's good to know. Okay.
Okay. All right. So other types of loans out there, there's some agriculture types of loans that are available out there. One is the Farm Service Agency, and one is the Farm Credit System. So it talks about that, the bottom there of 276 and the top of 277. It's pretty straightforward. Just make sure you read that. They could have a question about the agricultural loan programs. Next, I'm going to talk about other financing techniques on page 277. This refers to a package loan. We can go over this kind of quickly. The package loan is includes real and personal property in a package loan. Okay, so you get a loan for the property and some personal property too as well. A blanket loan covers more than one parcel. We used to get these when we got loans for, when I was with the home builder, we would get loans for several lots, like 20 lots we would buy to build on. And the bank would give us a blanket loan on them. And as we were able to build and pay off each lot, they would release a lot as we were to go. Okay? So that's one way to do that. The blanket loan covers multiple properties at once. A wraparound loan, I'm not going to get into that too deep. Kind of just read that. If you have any questions, I can answer off side, but they don't ask questions about that, so don't worry about that too much. Open-end loan. Open-end loan, you could get a question on. What is open-end? It's similar to a home equity loan insofar as it's going to give you, the bank's going to give you a loan based upon how much equity you have in your property. They're going to allow you to write a check for a percentage of that equity, and it's open. So in other words, you can write the check for it if you need it. If you don't, then you pay it off. If you need it again, we're just going to keep it open for you. We're not going to ever close it out. If you ever need it, it's there for emergencies, let's say. Okay? That's an open-end loan. Similar to a home equity loan, kind of the same thing. A construction loan is a temporary loan specifically for the purpose of making improvements on the property. They could be improvements, they could be subterranean improvements, they could be above grade improvements, whatever. So when you make an improvements, you're going to get a construction loan, and it's short term because when those improvements are done, the loan becomes due. So in construction loan, when you're building a house, typically comes in 4 increments. They call those takeouts. So it could be 4 takeouts. In other words, you're going to get $200,000, but you're only going to get it in 4 increments of $50,000 each. So the first part is when they dig the foundation, and they put the sewer lines in, and they put the plumbing lines in, and that's they'll get that the county to come out and inspect it, approve it, and then they'll send that to the bank. Bank says, okay, here's your first 50. Now you can start on the next one. You can pay the people that did that off, your workers that did that part of it. Now you start constructing the next part of it. All of a sudden the framing goes up, and the electrical wiring goes in, and the roof trusses go on. Okay? And now you get that inspected, and you send it up to the bank. Bank says, good, looks fine. Here's your another $50,000. Pay those guys off that did that work. Now you go to the next stage. All the drywall goes up. The exterior walls go up. The interior starts to go in. Kitchen goes in. Bathrooms go in. Okay? Now, that gets inspected. And you send that inspection report up to the bank. Bank looks at it. It's okay with it. You get your next increment. And you pay those workers off that did that work. The very final one, the home is all finished. All the landscaping goes in. Roof is on. Everything's all buttoned up and looking great. All the painting is done, and then you send that final inspection over to the bank. They send you the final amount to go pay your workers off, and now that loan is due. Now you have to get permanent financing, like a 30-year mortgage, to pay that loan off over time. Okay, so construction is for the improvement, and it's short-term only.
Okay.
Now, a sale leaseback on page 279, sale leaseback simply means I'm going to sell the property and I'm going to lease back the property I just sold. We used to do this in the home building. We used to build our models and then sell them, then lease them back to the people we sold them from, and still rent them back, continually using them as a model. This freed up cash for us to be able to build more properties out there. It was a good investment for people too. Because typically, when they first bought it, it was at a certain price. By the time we got finished that particular community, price usually goes up. So they were able to get a property that we maintained the whole time. They have to worry about maintaining it. and the value went up for them. So that's a sale and lease back. Okay? A buy down has to do, remember I talked about interest rates, and we talked about discount rates. And why would you pay a discount point? Because maybe you want to get a lower rate than the prevailing rate. That's called a buy down. And that's what this term over here on page 279 talks about, the buy down. You can have a permanent buy down, like I explained earlier, or you can have what's called a temporary buy down. A temporary buy down simply will buy the rate down for the first few years, then it goes back to the prevailing rate. We used to do this like what's called a 2-1 buy down. So let's say the rate's at 6%. So a 2-1 buy down would mean the first year it would go 2% the prevailing rate. So the first year would be at 4%. The second year would be at 1% the prevailing rate. So the second year would be at 5%. Then the third through 30th would stay at 6%, the prevailing rate at the time. It's all based on fixed rates. You're just temporarily buying it down for the first few years. It's not an adjustable rate because there's no index. You're just buying it down from the prevailing rate for the first couple of years.
Okay. There's no index, and we don't go according to margin. We're just gradually buying it down.
Right.
Okay.
Yeah, exactly. It's a buy down. Okay, home equity loan, like I said, it's similar to a home opening loan, very similar to that. Now I want to get over to page 280. We're talking about Truth in Lending Act and Regulation Z. So these are some of the regulations that lenders have to abide by. And the Truth in Lending Act, Regulation Z here was enacted by the Federal Reserve Board to enforce the Truth in Lending Act called TILA. What it does, it requires credit institutions to let borrowers to inform borrowers of the true cost of obtaining credit. So with these disclosures, they can compare the cost of different lenders so they can choose the best one for them. Okay? Regulation Z applies when a credit transaction is secured by a residence. So this Regulation Z isn't for all types of loans. So this isn't for personal loans. It's for residential purchase loans, is Reg Z. Okay? So what does it do? It gives us guidelines for how we advertise properties. It gives us guidelines for how we display the true cost of that loan. The Dodd-Frank Act combined some of these watchdogs and created this Consumer Financial Protection Bureau. It was created to, as a result of abuses by lenders. You can go to that website, consumerfinance.gov, learn more about that. I would encourage you to do so. In this paragraph, it talks about something called the annual percentage rate. Okay? I'm going to put this on camera here for a little bit so I can explain that. So an annual percentage rate is simply the amount as reflected as an interest rate, the amount of all of the charges for a particular loan. So an APR, inside an APR, is going to have the note rate will be in there, any kind of like the loan origination fee will be in there, any kind of discount points that were charged will be reflected in this APR, annual percentage rate. Any other loan costs are going to be reflected in this APR, annual percentage rate. So for instance, if I had a note rate, let's say was at 3%. I had a loan origination fee at 1%. My discount points, I have discount points of 2%. And I had another $700 in loan closing costs on this particular loan. So when I look at this, what's the true cost of this loan? Well, maybe it has an APR We don't add all these up because it's going to be over an annual percent, over a term of a year, okay? It's going to calculate what that interest would be for a year on the note. And then it's going to add in the amount of that loan origination fee, and it's going to add in the amount for the discount points. And it's going to take all that, and now let's see, and divide that into the loan amount, and let's see what kind of annual percentage rate. So maybe the annual percentage rate ends up to be something like 3.75%. Annual percentage rate. So the note rate is 3%. Your payments will always be based upon the 3%. Whereas the annual percentage rate is a reflection of the note rate and everything else stretched out over an annual period. It's a way for consumers to shop to see where I can get a better deal. So if ABC Company, ABC Mortgage, is offering this APR of 3.75% on a note rate of 3%, and then you might have XYZ Company Mortgage offering a 3% note rate, but an APR with an APR of 3.5%, that's going to tell you that XYZ Mortgage is not charging as much as ABC Mortgage is because their APR is lower. The note rate is the same. Both you'll get 3%, but ABC Mortgage has got an APR of 3.75, so your cost of that loan is a little bit more. Does that make sense?
Yes, it does.
Okay.
Mr. Joe, is there any way I can table it right here? Because I don't know if my granddaughter can.
That's okay. I'm going to continue. You can go ahead. You can go ahead and take off. I'm going to continue wrapping this up. I'm almost done. It'll be
okay. Yeah, I didn't want to be rude. I think she got some kind of splinter in her, but I'm sorry.
That's okay. I'm just going to keep on wrapping this up. All right.
Yeah, I'm still busy. I'm just not wouldn't respond if you ask me a question.
Okay. No worries. No worries. Okay. So that's what Truth in Lending and the TILA and Regulation Z is all about. Okay. On the bottom of page 280, it talks about this 3-day right of rescission. So for consumer credit transaction, for second mortgages, there is a 3-day right of rescission where you'll get the loan. You won't get the money yet, but you'll get the loan. You'll sign the papers. Then you go home and think about it. You got 3 days to decide if that's really what you want to do. If you don't, and you do, and you go back to the lender, you say, no, I just changed my mind. It doesn't feel good. I don't want to do it. They just tear that up, the loan up, like it never even happened. You won't get the money, but you won't have to be paying anything back either. So they give you 3 days of a look on that. That's a 3-day called 3-day rescission. Now, advertising. Reg Z provides certain types of advertising requirements. So in advertising, Reg Z says that if you're going to advertise like the interest rate, for instance, well, then you've got to also include what the term of the loan was, how much of the loan was for, what the interest rate was for. So you're going to have to, and then put the APR in there too as well. So in other words, there's certain what they call trigger terms. So they can't be advertised unless the advertisement includes all of the information. So you can't just put the rate out there. You got to put what the cash price is, the down payment, number of payments, the annual percentage rate, and the total amount that's to be paying back. That's all bullet pointed here on page 261. Penalties. Any creditor that fails to comply with the TILA is going to have some penalties, and they're pretty stiff. You want to be able to know what these penalties are, okay? So, could have punitive damages up to $500,000 or 1% of the creditor's net worth. That's a ton of money. We could be talking about millions of dollars here. So the penalties for violating Truth in Lending, TILA, and the Dodd-Frank is pretty stiff. Okay, at the bottom of 261, it's talking about I'm sorry, 281, it talks about the Equal Credit Opportunity Act, ECOA. So this refers to all the protected classes, and you see the gray box there at the bottom shows you the protected classes that lenders must be careful of not to discriminate on those protected classes. So you got race, color, religion, national origin, sex, marital status, age, and here adds receipt of public assistance. So this is different than the protected classes that we've learned about so far under the Civil Rights Act. So here, under ECOA, it adds in the receipt of public assistance. So people under public assistance cannot be discriminated against just because their money is coming from the government. The Community Reinvestment Act of 1977, the CRA, was updated in 95 and then again in 2005. Financial institutions are expected to meet and deposit credit needs of their communities. So they want to have them invest in local community developments, rehabilitation projects, participation in loan programs for housing, small businesses. They have to participate in their community. They can't just be given loans to high-end deals. They have to also work in the community and give loans to the public too as well. RESPA stands for the Real Estate Settlement Procedures Act. It stands for RESPA, that's what that stands for. And it's has to do with residential property transactions. And again, it's what created the TILA, Truth in Lending, that reflects this APR that I just talked about. Comes from the RESPA, Real Estate Settlement Procedures Act. Okay, and under there, also under RESPA, talks about the computerized loan origination programs. So these days, you can go into a lender and they'll take your information, they'll plug it into a system, a computer system, and they'll let you know right away whether you can qualify for that property, for that loan. So they do that, and I want to point out to you on page 283, there's something called the loan, where is it at here? Loan prospector under automated loan scoring. Loan prospector, there's something called loan originator. Okay? So those are the two types of systems that are used. The loan origination system helps them complete the loan application. Loan prospector is something that Freddie Mac uses for their loans. Okay, so just kind of know those two type of things, where they distinguish from. Loan prospector is for computer-originated Fannie Mae loans. Okay, and that wraps up this section on government involvement in real estate financing. So those are the two sections. Next, on Thursday, we're going to finish up the series with appraisal. And I think there's a few more things I'm going to do. This is my chart here.
I can hear you, Mr. Joe.
Yeah, next week we're going to go over appraisals, closing the loan transactions, and we'll wrap everything up on Thursday. So I'll be here Thursday at 6 o'clock, and we'll finish everything up. Okay?
Thank you so much, Mr. Joe. I'm really going to watch my class. I really appreciate that.
Terrific. I'm so glad you did. Thanks for asking all the great questions. I'm sure other folks, when they see this, will appreciate it and get some questions that they may have been thinking about you as well. So I thank you for that. Thanks for being here tonight. We'll see you on Thursday.
I'll be here.
Okay. Bye-bye.
Goodbye.